Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
So the butterfly, we have the butterfly is going to give us 3 month position where I'm going to buy one strike, sell two other strikes, and then buy another strike. So here's the example, or here's the forecast. I think that volatility is going to be reduced. That all of a sudden, for whatever reason, I look at the chart, or I think the fundamentals are going to tell me that the U.S. dollar, Canadian dollar, is going to start to trade in a very narrow range for the next 2-3 months. Now, I don't know how or why you would think that, but if you did, you could actually, and again, we're looking for averting disaster. These are all trades where I'm not risking a lot of money. When I'm saying risking a lot of money, I don't have open-ended risk. So in this trade, I'm actually risking very little. And I'm hoping for low volatility or lower volatility. So I buy the 107 put, sell two 110 puts, buy a 113 put. If I do all the math, add it all up, it's going to cost me about 53 cents, not including commissions. How much could I make? The difference between the strike prices, between the middle strike and either of the outside strikes. So that would be $3 width. So my potential reward is great. Again, if unchanged, you really, actually, if unchanged, I'm going to make quite a bit of money. So you need to do the math there. But if unchanged, that's what I really want to happen. And let me do the math because I'm showing that, according to the slide, I'm going to lose. But I'm actually, that 113 put's going to be worth $2.40. So that $2.40 profit or value subtracted out the 53 cents is going to be $1.87 profit. So that is a profit, not a loss. And again, that's a great trade there. If I just think that CDD is going to stay here in the next couple months. However, if it makes a big move down or up, I lose my 53 cents. So it's a sort of a way to implement a neutral forecast on the underlier with, again, trying to avert disaster. So how about buying a straddle? Well, I can do this. Now, this is actually a little riskier. So I guess this would fall under the category of averting disaster, but this is a little more risky. Buying the 110 call and the 110 put. So I would risk $5.45 with a tremendous amount or a substantial amount of reward. If I'm wrong, though, how much could I lose? Well, if you're wrong, you could actually, if it goes to 110, I lose my entire number, which is highly unlikely. But if it goes to 110.60, it stays unchanged. Well, then if it goes to 110.60, I lose $4.85. So more than likely, I could possibly lose about 70-80% of my money if nothing happens. So the butterfly would be if I expect low volatility. The straddle is if I expect more volatility. So again, this is a strategy to try to avert disaster, and this kind of trade you'd be looking for uncertainty. Now we're on to the strangle. The strangle, as I said, is buying the out-of-the-money call and the out-of-the-money put. So I hope the next time that Rob Booker comes back, you'll be able to remember these strategies, or you can go back to this presentation using the ISE podcast, as we have so much education now archived on the podcast. You can go back and go back, and if Rob says, okay, he thinks it's going to go to some number, and you really believe him, well, great. You can go back and look at some of these strategies and find the one that would make most sense for you. So you could use this presentation as a reference point. At least that's what I hope you do. Buy the 3-month strangle. We think there's going to be more volatility. Buy the 113 call for $1.81. That's not, it's one. Buy the 107 put for $1.23. Total cost is going to be $3.04. What happens if it stays at 110.60? I lose my entire investment. Think about it. I have the right to own the U.S. dollar at 113. I have the right to sell the U.S. dollar at 107. If it's trading 110, neither of those have any value. So I'm buying a lot of hope. Why is the hope so expensive? Because the market is volatile nowadays, and also because I have substantial rewards if the market makes a big move. Market goes to, let's say, 100. How much could I make? If it goes back to parity, well, the put would be worth $7. I would make $3.96. If it goes to 116, well, I actually just about break even because I have a 113 call, but I paid $3.04. Neutral on the U.S. dollar, Canadian dollar, I could sell an iron condor. So I could sell the out-of-the-money call, the out-of-the-money put. And what am I expecting here? Lower volatility. So I sell the 113, 116 call spread for 73 cents. I sell the 104, 107 put spread for 67 cents. My net credit is $1.40. How much could I lose? I could lose the difference between the two strike prices, $3, less my credit, $1.40. So again, this is a great way to avert disaster, because if you believe that the market's actually going to calm down and it's not going to go up all that much or go down all that much, well then this trade would work. And the other reason I like this trade is because you're averting disaster. If you're really wrong, if the U.S. dollar goes to 120, how much do you lose? Well, I risk $1.60. Let's say the U.S. dollar goes to 90 cents. How much do I lose? I lose $1.60. So my risk is limited. And basically I have a balanced risk reward. I can make $1.40, lose $1.60. Options are based on risk reward. The more leverage, of course, the more I can make, but also the lower probability event. So in the money, buyers have they have the least leverage. Short have the most leverage. So sellers, again, if you sell an in the money option, well, then you're going to have sellers, of course, will have more leverage. So you really want to think of it that way. At the money options, balanced and out of the money, long are going to have the most leverage. Short, if you're short an option, you're short the most leverage. If you buy an option, you're long the most leverage. High impact, each investor must determine what their risk tolerances are and also what are their goals. You have to decide which strategy is appropriate for you based on your portfolio. What's interesting about the ISEFX option is that they are not correlated. You see, out of the 6 pairs that we trade, 5 are actually moving straight up, even though that the U.S. equity market is going straight down. So you need to think of it that way. I mean, recently they've been very correlated to the bond market, not correlated to the stock market. And these correlations change, but again, if you're early on to these trends, you could do very, very well. High-impact strategies can be selected as desired. Simple calls or puts can be purchased. Debit call or put spreads can be implemented depending on your bullish or bearish view of the dollar. The amount of leverage can be selected by the strike price. So if I want more leverage, I buy a further out strike. If I want less leverage, I buy a strike that's in the money. And if I want to sell options, I could actually gain leverage by selling it in the money. Of course, my probability of success or my probability of failure is actually greater if I'm selling in the money option. High impact. Again, high impact, hopefully they're averting disaster. That's the whole theme of today's presentation. Neutral strategies can also be chosen, so I could do long volatility, buying straddles or strangles. I could do short volatility, short iron condors or long butterflies. So to summarize what we just spent the last 50 minutes on, ISEFX options allow investors to implement their own views of the FX market. Calls can be purchased to benefit from the dollar rallying, and we've seen the dollar having a tremendous move in the last 4 months. I mean, nobody could have expected this. If you think that the dollar is going to actually retrace a bit, well, this is a great opportunity. Just buy some put options. Give yourself some time, though. Leverage is determined by the strike price selected, time period chosen, and the specific strategy that is implemented. Investors should always consider, always consider risk reward prior to entering any options transaction.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.